Okay, 103 Central, 1103 Pacific. This is the macro and markets presentation for the second quarter 2021. I'm Michael Dow, Beacon Pointe CIO. There's quite a bit of information to discuss today, so let's jump right in. Before we get started on the formal presentation, you can keep in touch with Beacon Pointe by listening to our Dollars and Cents podcast or the Markets in Motion podcast. Both very interesting. Dollars and Cents by Kobe Kress and Karen Reifel. I do the Markets in Motion. It's a 15-minute quick update for those interested in macro and market developments, whereas Kobe and Karen have a lot of information that's very relatable to help folks navigate life moments. So keep in touch with us on the podcasts on timely topics. This is Macro and Markets. Before we get started, thanks for joining. Navigating the webinar functionalities is pretty straightforward. If you want to be on speaker view, go here. There's Q&A. We're going to do a Q&A at the end of the presentation. So go ahead and submit your questions, and we'll get to them in about 45 or 50 minutes. A lot of information to discuss today. There's plenty going on. Clients have a number of different questions. We'll begin the presentation with a quick overview of the global macro, and then jump right into our secular theme, which for the last 12 or 14 months has been focused on the aftermath of the stimulus. So we wrote a paper on this last summer. It was called Investing in a World of Financial Repression. I'll define financial repression and talk about why we think it's the most important thing for clients to understand about the investment environment for the next 3 to 5 years. Our cyclical theme, that is our 2 to 4 quarter theme, centers on slightly higher interest rates and a rotation out of what has been an excellent asset class, at least up until a couple of months ago, large cap growth. Rotation into what? Well, the cyclical, more cyclically oriented risk assets, which would include small caps, large cap value, and international equities. But the big topics and the bulk of the presentation I'll spend on the three things that are generating most client conversations. Inflation, what does it mean? Taxes and upcoming tax policy, and Bitcoin. And then we'll finish up with portfolio implications and the risks to our current outlook. So beginning with the global macro update, this is the purchasing manager indices from JP Morgan. Red is bad, green is good, and it highlights the fact that this was the shortest global recession on record. This is the global PMI here. It dipped to as low as 26. Anything above 50 is expansion. Anything below 50 and 26 is an incredibly low print. You never see 26s. Developed market, emerging markets, everyone was affected by the lockdown, but it was swift. And I'd highlight here, for example, China was the first to enter a recession and the first to come out of it. But as it stands right now, the entire globe is now well into expansion mode. The U.S. is leading the way. So the U.S. authorities, policymakers, both monetary and fiscal policymakers, have done a tremendous job in getting us through and out of and into a new, potentially more normalized economic environment after what was an amazing and unprecedented economic sudden stop in U.S. economic activity. Here's the global economic activity indicators. Again, there was more detail on the prior slide, but this tells the same story. We had a pretty big dip, but everybody's in expansion now, and things seem to be picking up steam. And in fact, there's a real risk that the global expansion might overheat a bit, which is why we're having so many conversations with clients about inflation. So what's driving the global recovery? One of the key elements and a key theme is global monetary policy accommodation. More central banks have cut rates since March of 2020. 28 central banks across the globe have cut rates. Only 7 have increased rates, and that's only been recently. And global central bank rates, that is the average rate that a central bank charges on the interbank lending market, has collapsed. And you can see here, even the emerging markets went from 5% down to below 3%, and developed markets on average went from 0.5% to 0. So we're at the effective lower bound. Most global central banks in the developed world, including Japan, the European Central Bank, and of course the Fed, are smashed back down onto 0. And there's very little scope for increasing the monetary policy target rate in any developed market anytime soon. Although if inflation does become more persistent, then it will become a topic of conversation. But it's been massive global central bank easing that's led to the recovery we've seen in markets. A quick snapshot of the U.S. economic data. I'm going to leave this in the presentation as read, but it's GDP here. We had a 6.4% GDP print in the first quarter of 2021. Financial conditions, incredibly important. I'll talk a little bit more about them. The unemployment rate has recovered dramatically, and inflation to date is still running below the Fed's 2% target. Although this is as of March or April 30th, we've got a recent print that's a little bit higher. And when you look at U.S. CPI headline, well, yesterday was a bit of an interesting day in markets when we got the CPI print, and I'm going to spend some time talking about that. So what is it about financial conditions that's most important? First of all, it's important to the Fed, and that makes it important to us. These are market observable data series, including the level of the S&P 500, volatility of the S&P 500, interest rates and credit spreads, and U.S. dollar. Taking them all together, they tell you a lot about where economic activity is headed. If financial conditions are loosening, as they have in the second quarter, then that bodes well for GDP 2 to 4 quarters out. So economic activity, you would expect it to be restrained as financial conditions are tightening, which they did in the first quarter of 2021. But as interest rate rises began to taper off, and as the equity market regained its momentum, the financial conditions index began to loosen again. And again, that bodes well for GDP in the future. Quick note on vaccines. They've peaked and are now plateauing and have rolled over. This is a little bit interesting. I don't know if disturbing. We've gotten a lot of folks vaccinated. So 150 or 160 million people in the U.S. have gotten at least one. So perhaps a slowdown was anticipated, but this bears some watching. The bottom line is, as it relates to economic reopening, the most important thing is getting to some semblance of herd immunity, which the CDC says is between 70 and 80% vaccinated. And right now, at the current pace, it looks like we could get to herd immunity in the United States by the middle or end of July. Again, 140 plus million people have been vaccinated with at least one dose, and almost 100 million, this is as of a week ago, have been fully vaccinated. So this is all good news for the economic reopening trade. In terms of the global numbers, used to be that the just 3 months ago when I first presented this slide, it was going to take between two-thirds of a year and up to 9 years for Canada to get fully to get to herd immunity. Those numbers have come down dramatically, and in fact, you can ignore them now. As it stands, Italy, Germany, France, Canada, et cetera, they're all going to be achieving a potential herd immunity. There are some countries, less developed nations, that are not doing as well, and we'll look to and hope that situation improves in the near term. That will it'll be necessary to completely eliminate the risks, at least in the near term. It's not understood yet whether or not COVID is going to be with us on a more persistent basis, but as it stands, things are looking up from an economic reopening perspective in the developed world, somewhat less so in the emerging world, but the emerging world is expected to catch up soon. What does all of the vaccinations mean for restaurant bookings and travel? Well, restaurants are now running at about 80% of capacity, and air travel's back to above 50%. And if you've been in an airport lately, there's a lot of folks that are anxious to get out and travel. It can be pretty busy. I've done a little bit of traveling lately, and I've noticed a pretty significant uptick in the crowds that are in the airports with the vaccine developments. That can only improve. But we're about halfway back to the capacity that we saw in terms of air travel as of a year ago, and in terms of restaurant bookings, we're nearly all the way back. So how do we get here in terms of economic recovery? And then I'll dive into our thesis on financial repression. A good measure of it is because of the fiscal policy, the unprecedented level of stimulus that's come from the federal government, and in addition to the Federal Reserve. But here is just a summary of what it actually has been delivered and proposed. So delivered is on is all of the things that were in 2020 have now been enacted, and that's quite a sizable amount of stimulus, about 3+ trillion, closer to 4 trillion. And then in 2021, the American Rescue Plan was signed into law in March for another 1.9 trillion. And the two plans that are on the table now are the American Jobs Plan, 2.3 trillion, American Families Plan, 1.8. These are different, these two, versus what we've seen before, and we'll talk a lot about it because tax policy is top of mind, and it's wasn't top of mind before. Why? Because the American Rescue Plan was funded by debt, whereas American Family Plan and American Jobs Plan are both being funded by increase in taxes. So there's a fundamental difference in getting things done in Washington, D.C., whether you're going to ask taxpayers to pay for it currently or in the form of higher debt and debt issuance at the Treasury, pay for it in the future. So we'll talk more when we get to the tax policy section. We've talked a lot about global monetary policy accommodation. The Fed's been no different. The Federal Reserve's balance sheet, or a representation of the quantitative easing that we've seen since the beginning of the COVID recession, has been nothing short of extraordinary. We were at about a $4 trillion balance sheet back in March of 2020. It's up to almost 8 trillion now. It's probably going to 10 trillion. And for that 3.6 trillion of additional dollars that have been sent into the system, into the financial system, in order to provide liquidity, ease the credit crunch, and to boost the economy, for that 3.6 trillion of additional QE, we've gotten about 2,000 points, just under 2,000 points in the S&P 500, at least as of May 7th, end of last week. We've shed about 3 or 4% since then, although things seem to be stabilizing today. Why do we think the economy is going to boom going into the second half of 2021? That's easy. All signs are pointing towards a significant recovery in the consumer. So personal consumption expenditures are a significant portion of GDP. They're 2/3 of the GDP calculation. And consumers are in great shape with the fiscal stimulus we've seen and a lack of opportunity to spend, particularly on services. Personal savings rates are now elevated and approach 30%. The average personal savings rate here in the United States is less than 9%, and we're at 30% now. So there's plenty of dry powder for spending. In addition, if you're a homeowner or if you have an equity portfolio, both of those assets, which a good measure of Americans do own, at least particularly home ownership is significant. Your house is up 12 or 13% in the last 12 months, and the equity markets are also up big, 60 to 80%. And as a result, you've got a boost from what we call the wealth effect. So if you feel more wealthy because your house is increasing in value and your 401k statements or your stock portfolios are increasing, that tends to translate into higher consumption and higher personal spending. So we've got dry powder and we've got the wealth effect. Both of those should propel GDP growth forward in the second quarter by the consumer. If you take the outliers out of gross domestic product and look back over the last 8 to 10 years, and when I say the outliers, the scale here doesn't allow us to show the first, second, and third quarter of 2020. The first quarter was down 5%, so that would be about here. Second quarter, of course, was down 30%, would be completely off the charts, and the third quarter was the rebound at plus 33%. So just taking out the outliers here and showing you where GDP has been and where the averages have been and what our outlook is going forward just highlights how significant a recovery we're expecting in the second quarter and the third quarter of 2021. So we're looking at prints that are rather unusual given the handle here. So you got an 8% print, a 7% print, on top of the 6%, the 6.4 we got in the first quarter. So it's a rather extraordinary recovery that we're expecting. And again, to tie into some of the other topics we'll get to, typically inflation tends to follow economic growth, especially if economic growth is moving faster than the potential of the economy. The economy has a speed limit. It's called potential GDP. If actual GDP is higher than potential GDP, that tends to be inflationary, and potential GDP in the United States is well below 8%. But we have a little bit of catching up to do given what happened in the second quarter, and I'll talk about that in a second. But we are expecting a very sizable and material economic recovery. Our forecast here at Beacon Point: GDP above consensus, inflation above consensus, unemployment then, given the higher degree of economic activity that we expect the labor market to recover faster. And as a result, we are actually predicting a Fed funds rate hike in 2022, which is well before either the market thinks the Fed is going to move, or before the FOMC, the Federal Open Market Committee at the Federal Reserve, thinks, as indicated by the dot plot, which is their forecast for rate hikes. They don't have one penciled in until at least 2023. So this is the summary of our outlook, and in the cyclical outlook is here, along with, again, just we'll talk about it in a second, a summary of the financial repression or secular outlook. But it really boils down to this: the economic reopening is a function of positive vaccine developments, and the vaccine distribution effort has been nothing short of amazing. And as a result, the economies, not just here but other developed markets, are opening up pretty swiftly. You add to the reopening trade the massive amount of fiscal stimulus that both has been enacted and is being contemplated currently, and all of the quantitative easing in terms of stimulative monetary policy, and you add in the consumer rebounding because of the savings rates and wealth effect, that would lead you to be cautiously risk on. We were not as cautiously risk on 90 days ago when I presented last. We were just plain risk on. But as the market has continued to rise and as valuations have moved into potentially a little more stretched levels, it seems prudent to start to look at what the future will hold. All of this is good news in terms of vaccine developments and stimulus, but what we really want to do is make sure that we're taking risks on behalf of clients where you're getting compensated for those risks. Is the earnings yield high enough? Is the interest rate yield high enough? Is the credit spread high enough? Those compensation metrics are very important. Right now, it's tough to make a strong case, given the absolutely unprecedented recovery we've seen in equity and fixed income markets, that anything is trading really cheaply. So we're cautiously risk on given these positive developments, but there's clouds on the horizon, and we just need to keep an eye out for the coming clouds. And I'll talk about what happens generally in a normal equity market year as it relates to having a drawdown or negative performance period, and what that means for client portfolios. It happens a lot, and we should expect it. We should anticipate it. If we anticipate it, we can deal with it more effectively, and I'll get to that slide in a moment. So let me just briefly summarize what has been our secular investment theme for the last 10 or 12 months since the COVID recession began 14 months ago. And we've titled it Financial Repression. What is financial repression? Financial repression is official policies that artificially lower the government's cost of debt to maintain the sustainability of that debt. Why is this important? If you create a mountain of debt, you need to be able to roll it over at a cost-effective rate. And if you're federal government, you do have some measure of control over interest rates through the quantitative easing process, or if necessary, another tool that's in the Fed's toolbox, something called yield curve control. So the Fed can buy either short duration assets or long duration assets. When they buy short duration assets and pump money into the system through that mechanism, that's quantitative easing. Yield curve control is the purchase of 5, 7, 10, maybe even 30-year bonds. And if you do that, you tend to push the yield on those securities down. And that's yield curve control. It's financial repression, broadly written, and it's necessary in the current environment. Why is it necessary in the current environment? Because when you had this massive GDP shortfall, the economic sudden stop that we saw in March, April, and May of last year, and you had a second quarter GDP print of minus 31%. Third quarter, of course, was a nice recovery of 33, but you had this minus 31%. That needed a response, and the response came in the form of both quantitative easing by the Federal Reserve and fiscal stimulus. Fiscal stimulus that wasn't paid for with taxes, but was paid for with future tax revenues in the form of massive debt issuance on the part of the U.S. Treasury. So the Treasury issued bonds, the bonds were bought, the money was spent. We'll have to pay for it later, but GDP, higher GDP would be better. And just to put the 8.2% we expect for third quarter 2021 into context, this is 70 years of GDP history here. And while the losses in the second quarter of 2020 were staggering, we are expecting a very robust recovery, particularly from here, 6.4 first quarter, 8.2 second, and 7.4 in the third. Those would be historically very high numbers. In the last 40 years, you haven't seen anything like it. So very robust recovery expected. The labor market has also recovered very swiftly. This is 70 years of unemployment data going back to the late 40s. We did have a peak of close to 15% on the unemployment rate, but we're back down to 6% now, and we figure in the next couple of quarters we'll be closer to 4.2, which is about the non-accelerating inflationary rate of unemployment. That's the NARU. The NARU is where the Federal Reserve used to get very concerned about inflation. That is, when the labor market tightened, the Fed would typically, and prices rose, the Fed would traditionally raise interest rates as soon as you get close to kind of the 2% inflation target. That's no longer the case. Now we are in a new regime of average inflation targeting, which I'll discuss in a moment. But the aftermath and the issues that we need to address, and why financial repression is our best guess for how things are going to play out over the next couple of 3 to 5 years, is because you had all these deficits, 16% deficit in fiscal year 2020, which ended last September, and all this debt issuance. This is, again, 70 years of history. Back in the post-World War II period, we were at about 119% total. That's federal plus state and local. And now we're heading towards 150%. So we just have never been in the same kind of a debt situation. This debt mountain, it causes risks. It dampens growth, and it increases your exposure to exogenous shocks. So it is imperative, and it's on policymakers' mind in DC, that this needs to be dealt with. How do you deal with it? Well, you can't balance the budget very easily. That would be one way to go, but we haven't had but a handful of surplus periods in the last 60 years. It's just very difficult to balance the budget. It means raising taxes and cutting services, and very few politicians are willing to take that approach. So that's probably not it. Getting to a primary surplus is just not easy, but you do need to manage, and you do need to manage the debt service. So what are the implications of all of the stimulus? Higher debt and deficit, higher taxes, lower growth rates, and frankly, the quantitative easing part is the easiest to understand, the money printing, and lowering nominal interest rates and increasing inflation. So if you actually print a bunch of money, it generally generates higher inflationary expectations. That will generally, again, push nominal interest rates, those are the observable interest rates, higher. If you push nominal interest rates higher, that reduces your capacity for debt sustainability, and it increases your cost of debt issuance. So you must repress. This is the imperative for financial repression. Higher nominal interest rates make the government's job of financing the budget deficit that much more difficult. You repress rates, hence lowering nominal interest rates, but you still have this higher inflation piece, which leads to negative real interest rates. Lower nominal interest rates plus higher inflation gets you to the hallmark of financial repression, which is negative real interest rates. And we think this is a persistent feature of the investment landscape for the foreseeable future. So again, you can reduce government debt in a couple of different ways. Growing your way out of it while we're trying with the fiscal stimulus, and that will continue to be beneficial. Adjustment, which is balancing the budget, very hard to do. Or you can default on the debt. That's how you reduce government debt. But only Greece has done that relatively effectively in the last 20 years in a quote unquote developed market. And inflation. Inflation is another way to do it. So you take financial, you repress nominal interest rates, you increase inflation, and you turbocharge your debt mountain reduction through negative real interest rates. Where are we right now? Well, let's just, this is the only equation I'll include in the presentation today. But if Treasury yields are about 1.5%, and they're closer to 1.65 today, but just for round numbers, if you have a 10-year Treasury that yields 1.5%, and inflation expectations are hovering around 2.5%, then you have negative 100 basis points of real yield. So you repress nominal rates, you increase inflation, and that actually generates the negative real interest rates that are effectively a revenue item for the government, and that helps to turbocharge debt liquidation. It's very important. Just a couple more slides, and then we'll move on to the current environment. The interest paid on government debt is very sensitive to nominal interest rates. If you look at what we paid on government debt, or the average interest, it's hovered between 1% and 3%. And that's come down recently, and it's stayed very low recently because interest rates are very low. But now we have this mountain of debt, and the debt service payments on an annual basis are highly sensitive to it. If you increase interest rates, if interest rates go down to 1.5%, you stay very low, or stay at 1.5% on average interest paid. But if average interest paid on the government debt rises, that is, if the government is unsuccessful in pursuing financial repression, we'll be at 3.5% pretty quickly, and that will cause total debt service payments to go from below 2% to almost 5%. And this would be a real problem. Policymakers are very aware of it, and that's why we're going to have financial repression. So where are we in terms of a scorecard? Short rates are at 0, and that's where they'll stay. Nominal yields seem to be capped. This is 10-year treasuries below 2% plus or minus, and inflation expectations have risen dramatically. So short rates at 0, 10-year yields very low, inflation expectations higher. I mean, all of this has occurred in the last 10 months or so. Job done. Everything seems to be pointing towards the thesis proving itself to date. And this is an important slide. It's negative real yields going back 20 years. We'll have another slide going back 70 years, or actually back to the 1820s. And we'll see that it's not uncommon, but it's pretty rare, but not unprecedented to have negative real yields. We just think it's going to be more persistent than the experience we had in late 2012, early 2013. So negative real yields, they're negative 100 basis points, and they are your direct evidence that we are in a period of financial repression. And just to put a fine point on it, we've been here before. We've done this before. Going back to the 1820s, there's these random inflationary spikes that created negative real yields, but here it was done intentionally. The Federal Reserve and the Treasury Department got together, colluded on interest rates, and said, okay, for the next 20 years, we're going to have low or negative nominal, or low or negative real interest rates. And by doing so, we're going to reduce the debt mountain. So here's the World War II debt mountain. Back in 1947, it peaked at 120%. To get it down to 30%, you produce financial repression policies, generate negative real or low. These are low real yields here, this environment, and negative real yields. And this is how you do it. So it's not something we haven't seen or done before. The question is then, what's the limit? How much debt can the Federal Reserve buy in an attempt to sort of devalue? It has devaluation implications. How much debt can we issue? How much money can we print? And the limit of our ability to pursue the policies that are necessary is our status as the world's reserve currency. And how do we measure that? You measure that by the percentage of US dollars that are represented in the composition of global foreign exchange reserves. That is, you total up all the central bank balance sheets across the world, and just under 60% of the assets of those central banks remain US dollars. US dollar is the reserve currency because it's the most liquid, tradable. We have rule of law. We have the deepest capital markets. We have the deepest and most open currency and U.S. Treasury and government bond markets. All of those things allow you to be point to your currency being the reserve currency. There's no other currency that even comes close. The euro is 20%. The Japanese yen and the pound are just under 11%. And recently, the IMF started to identify current forex reserves in the Chinese currency, the yuan or renminbi, and it's about 2% now. And just as the trend is that the renminbi assets have doubled, whereas the U.S. dollar has declined in terms of its prevalence as the U.S. as a global forex asset. But we're not in any imminent danger. The trend tends to be cyclical. The value of the U.S. dollar has something to do with how this is calculated. With the dollar decline, that doesn't mean we're losing our reserve currency status, just means that the dollar value of global reserves is declining. So this could go down further, and it wouldn't necessarily indicate that we were losing our reserve currency status. We're keeping an eye on it. One of these days, I mean, reserve currencies are cyclical, but we've been since Bretton Woods in the 1940s, and it was the pound for 100 years before that, and the guilder before that. So things change, but it isn't going to happen anytime soon. It's going to be decades before anyone challenges the preeminence of the U.S. dollar in global transactions. Just a couple of quick notes on our rates and rotation thesis. This is the U.S. Treasury 10-year yield back during the COVID recession. It went down 140 basis points, and then U.S. Treasury yields went up 120 basis points as bonds sold off. It's all part of the reflation trade, and interest rates should rise if the economy is recovering. And typically what you see is value and small caps are favored in this environment. As interest rates rise, the discounted value of growth stock earnings actually declines because they're further out in the future, and value and more cyclically oriented small caps tend to look a little better on a DCF basis. So as interest rates decline, growth was preeminent, but as interest rates have risen, we're seeing a rotation out of growth and into small cap and large cap value and international equities, less so because of the challenges of the dollar recently. But we anticipate that this rotation out of large cap growth, which has done so well and did so well for the first 7 or 8 months post-COVID recession, is likely to persist. So inflation expectations are driving yields higher. Not only inflation expectations based on the reflation or economic recovery trade, but because of all the fiscal stimulus, the U.S. Treasury is issuing billions and billions of dollars, and in fact, hundreds of billions more than average. So here's Treasury issuance. We issued 2.5 trillion of treasuries this is on a monthly basis in billions. 1.8 trillion is the most recent print. The average is about 860 billion. It's just absolutely astonishing. This is gross issuance, so it's very large numbers because there's net issuance that most people look at that adjusts for pay downs and maturities and things. But this level of issuance is absolutely unheard of. So let's talk about why we're going to continue to see massive debt issuance, because there's so many. The likelihood of budget deficits remains very large. So the CBO is forecasting budget deficits of between 5 and 7% out to 2030, and the estimates for government debt issuance are here. They are updated every quarter at the Treasury Borrowers Advisory Committee meeting. So you're going to have deficits, and you got to fund them with debt. And here is a couple of more numbers. The fiscal second quarter of fiscal year 2020, you had almost 2 trillion of net debt. That's net of the of maturities, et cetera. We're expecting in the third quarter of fiscal 2021, 500 billion and another 800 billion in net debt in the fourth quarter. The fourth quarter fiscal year ends on September 30th, by the way. And debt issuance and inflation expectations are pushing up the future expectations for 10-year Treasury yields. All this tells you is that by 2025 or 2026, the market's currently pricing in Treasury yields that are 100 basis points higher. That's really not a lot, and we'll talk about what that means. This chart simply highlights the rotation. So out of large cap large cap growth and into small cap and into value. And it also highlights that the EM, emerging market equities trade, hasn't quite worked. The blue is the return of large caps from the depths of the COVID recession on March 23rd, right up until the end of the third quarter of 2020, and then picking up again on November 1st until last Friday. You can see what's happening. So the initial response in the post-COVID was up 50% for both large and small, up 35%, up 63%. Growth considerably outperformed value in phase one, the first stage of the recovery. Then the orange here is the most recent period. So you've seen a reversal, large caps underperforming small, value outperforming growth. And so far, S&P and developed equities about flat in the last 6 months, but emerging markets still lagging. That's a dollar story, and I mentioned earlier it's probably a vaccine distribution story as well. So we've seen an increase in interest rates from very low levels, but this is 230 years of interest rate data here. This is the recent increase from 50 basis points and tripling to above 1.72. So you've got this very sizable, very relatively quick increase of about 120 basis points off the lows. And as a result, and I just wanted to put this into context, this is 230, this is 9 months of interest rate data. It's this same exact, on the same scale, the different scales of the graphs, but this red arrow and orange square are the same. So it's not much on the grand scheme of things. Just to it's very historically low still, so not a problem, but inflation is. Inflation could be a problem. Inflation is getting a lot of press. Let's jump right into inflation. Yesterday, we had the highest inflation print since 2008. So what does it mean? We had a 4.2% print. If you go back 15 or 20 years, no, we haven't seen anything quite like it. But note for the record that the orange line here, which is headline CPI, is very volatile. Core CPI, which takes out energy and food, is actually a lot less volatile. Now, of course, you can't live without energy and food, and the 3% is actually a pretty high number as well. But it's also coming off a very low base. We were anticipating this, and frankly, the Fed is likely to insist that this is transitory. What caused the 4.2% increase in CPI inflation? Yesterday, it was mostly energy and frankly, an increase in used vehicles. So 4.2 is the contribution to the 4.2 from energy is 1.7. The contribution to the 4.2 of increases in prices in used vehicles is 0.6. So that accounts for the vast majority of the increase in CPI, energy and used car prices. But again, the Fed is likely to continue to view this as potentially transitory, but it's something to keep an eye on. This is a similar chart. It just shows the increase in used cars and energy and the various weights and importance of the components of CPI. So while used cars and trucks are increasing at 20% and energy at 25%, there's a couple of very sizable components of CPI, owner's equivalent rent and food and beverage, which total to almost 40%, that are hovering around 2 to 2.4%. So you had this spike yesterday. It was concentrated in energy and used car prices. And again, I guarantee that the Fed will continue to tell you that it's a transitory burst and that the market should try and ignore it. But there is some worrisome signs on the horizon. I'm going to take a look at inflation expectations now. This is what the market's actually not so sanguine about inflation. It's thinking, 2.7% now, up from 0 practically a year ago for the next 5 years of inflation. So very high number. Haven't seen anything like this since 2007, and it's come up very meaningfully. These are inflation expectations that are built into TIPS prices. This is actual inflation. Actual inflation a year ago was less than 1%. And now it's approaching 2%, but it's still below the Fed's 2% target. But most of this is because they were so low a year ago that the base effects, that is off of a low base, means that inflation is going to print high, and we expected it. What's driving inflation? Well, for the last decade, we had this forces of disinflation. Demographics, the overhang from the great financial crisis, and frankly, technological disruption is very disinflationary. The forces of inflation, money printing, and the Fed's new move to average inflation targeting. Average inflation targeting is a game changer if you're a Fed watcher. It basically means the Fed is going to fight deflation or disinflation now and not inflation. The practical application, unemployment's going to go lower than it would have otherwise, and the Fed's going to allow inflation to run hot. There's a bunch of other things that are happening that are causing inflation to be potentially a problem in the future, some of which are transitory. We'll talk about how transitory inflation gets pushed into, more persistent inflation in a sec. But one of the biggies is supply chain disruptions, and a lot of folks have a lot of questions about that. Supply chain disruptions are definitely inflationary. They're causing bottlenecks in labor markets and in goods markets and housing markets, and all of that is going to push prices up. But the biggest one is the declining amount of economic slack. So there was a big hole that was blown in the economy a year ago, probably about $2 trillion difference between potential nominal GDP and what we actually got a year ago. And that created economic slack. But all the fiscal stimulus and all the monetary stimulus is creating a pretty swift closing of the output gap. Plus, there's a less important feature of the current environment, which is a reversal of globalization. But it's really the supply chain disruptions and declining economic slack based on the stimulus that is causing the problems today. A lot of people are really worried about inflation because the monetary base has increased. So I'm from the University of Chicago, so I'm steeped in some of the monetarist tradition. But I think there's a lot of folks out there that are misusing the quantity theory of money to suggest that just because the monetary base is up $3 trillion off of 15 trillion, so call it up 20+% in the last year or so, that all of a sudden prices are going to get out of hand. This is the Fed balance sheet here, and this is the M2, but that's just not true. Money supply growth and price increases don't go one for one, hand in hand. There's a quantity theory of money of equation that needs to be addressed. And the quantity theory of money, just to say, to summarize this chart, price rises are not just a function of monetary, money supply increases, but they also are affected by the velocity of money and real output. I wrote a piece on this internally, and if anyone wants to talk more about the equations, I'd be happy to do it. This is the most important one. Looking at growth of M2 versus PCE inflation, there doesn't seem to be a very strong link. And in fact, the R squared, or the ability for growth in M2 to explain inflation, isn't very high given this low R squared. And in fact, it's kind of going in the wrong direction. The sign on the coefficient is actually the wrong one. But so we have had a substantial increase in M2, but inflation hasn't risen. And in fact, even though M2 has increased for the last 20 years, inflation has been on a secular downturn. It doesn't mean that will be persistent or will continue, but we'll have to keep an eye on it. This is just a rationale for average inflation targeting. This is the Fed's goal, is to get to inflation to 2%, and we've been well below it for the last 25 years. And in fact, for the last 3 years, we've been closer to 1.67% versus the 2% the Fed's looking for. We're at 1.83 now. Average inflation targeting basically means, and we don't really know what period the Fed's going to average inflation over, but if they need to average 2% over, call it a 4 or 5 year period, well, they need to let inflation run close to 2.3% for the next 3 years, because for the last 3 years, average personal consumption expenditure deflator has been 1.67%. So average last 3 years, 1.6. To get to 2% on average, you need to let inflation run hot. We're heading there, and maybe we're already at 2.3, and that should not be scary. The Fed will allow that to happen. Here's the rationale, by the way, for the output gap closing at a pretty swift pace. I mentioned that the proxy for the output gap that we saw, the hole that was blown in the economy a year ago, was about $2 trillion. Here's a summary of all the fiscal stimulus by phase. So here's the CARES Act, here's the American Rescue Act, here's American Jobs Act, and here's the American Families Act that are being proposed. So these haven't been enacted yet, but all of this has been enacted, and it's heading towards the economy. If all of it gets enacted, and it won't, we'll get to 9.7 trillion of fiscal stimulus to fill a $2 trillion hole. Add to that the 7 trillion of increased monetary stimulus that we could see by the end of 2023, and it's not clear that we wouldn't have a booming economy for sure, whether or not it generates a persistent level of inflation. By the way, the Fed has all the tools to deal with inflation. They've done a great job in the last 15 years navigating first the great financial crisis and then the COVID recession. But if we do get inflation, they know exactly what to do. We don't know, though, what that will mean for risk assets, but they know how to deal with inflation, so it won't be persistent, but we just need to be careful keep an eye on Fed policy and try to make sure we're understanding exactly how they're reacting or what their reaction function is. And our view is that their reaction function has changed dramatically with the introduction of average inflation targeting. So here's job growth is slowing down, and it's because businesses are finding hard to get workers. So in a survey, 44% of businesses are saying they can't fill jobs. This is non-farm payroll. It was supposed to be closer to 1 million last Friday, but it came in at 266, which is very disappointing. So job growth is slowing down. One of the reasons might be because there's a headwind to employment growth. In some cases, for example, the minimum wage is nationally is 7.25, but if you're taking unemployment, you're getting compensated about $4 an hour more than that. So there's a modest disincentive in some areas, in some of the in some businesses and in some job categories to going back to work right now, and that's going to continue to slow job growth. Unfortunately, that has a potential to increase wages. So here's some surveys of jobs hard to fill, which was on the prior slide. It's the highest on record. Jobs hard to fill, going back 50 years, it's never been this high. And plans to raise wages by companies, firms planning to raise wages, is recovering and actually tends to follow jobs hard to find. So this might suggest that there's a potential for increasing wages in the near future. And if that happens, that's the kind of inflation that the Fed worries about. It's much more nefarious if it makes its way into wage increases as opposed to transitory energy price hikes. So the Fed does care about this, and this is something that definitely bears watching. Back to bottlenecks in the economy. Businesses are reporting record high levels of delivery delays. So this is the supply chain disruption argument. Clearly it's happening. And the supply of houses is down to 3.5 months, where it generally averages something closer to 5 months and has been as high recently as 6 or 7 months worth of housing supply. So with very limited housing supply, there are bidding wars and things are pushing house prices up, which we've seen on an earlier slide. So the bottlenecks are creating price pressures. These are the ones that the Fed would consider to be self-correcting. But wage increases, given the stickiness of wages, would be something that would be very worrisome to the Fed. A couple of quick slides on global economic commodity price movements. So with the reflation trade, that is the increase in the global purchasing managers index, copper has ripped higher, as has oil. Those you would expect. Those are they're very sensitive to the global economy, and they've seen massive recent price increases. All the construction-related commodities are also up. This is lumber and iron ore, the basic ingredient to steel. And lumber's up 300%, iron ore is up 300%. It's perhaps not a surprise, but with lumber trading at $1,600 per board feet, 1,000 board feet, this is just not. It's almost four times the price that it was trading at just 6 months ago. So this is causing some problems, particularly for home builders or people looking to buy a new house or people looking to do rehabilitation or other construction. It's just going off the charts. 10-year yields, we already talked about the fact that the recent price movement isn't, so even with all of this inflation, again, I just want to, this is important, so I'll say it twice. The movement up in interest rates has been pretty big if you're off a low base, but in the grand scheme of things, it's not that high. Let's talk about taxes. If you try to take capital gains taxes up to 40%, which we've done in the past, in the 70s, it was raised to 30 and then 35 and then 40%. Unfortunately, tax receipts decline. So you raise the corporate tax rate and you lower the actual tax receipts. And that's happened a couple of times in the last 70 years. Every time you raise and every time you lower capital gains taxes, tax receipts, the thing you're trying to get to, the thing you're really trying to maximize is tax receipts, so you can, particularly in the current environment, so you can pay down debt. It's a losing game. So there is some level by which tax rates and tax receipts are maximized, and it's kind of a repeating game and strategic game. You just have to figure out where it is. It's not 40%. It's probably something on the order of 28 or 30%. So we might see a pretty significant rise in capital gains taxes, and I'll talk about our views on that in a sec. But there is this negative relationship between tax receipts and tax rates. That is, every time you increase tax receipts, you get this negative sloping line. Realized tax receipts go down, and it's a meaningful or a statistically significant relationship. So clearly, policymakers are aware of this. A 40% long-term capital gains tax rate doesn't seem doable. One of the other things that I'd like to point out is interest or tax rates, both personal tax rates, which were at 90%, by the way, in the early 60s, corporate tax rates, which come down from 53% to 21%, and long-term capital gains tax rates historically have all been on downward trends. That's good. Bad news is, so has government infrastructure spending. It's been cut in half over the same period. So there is a strong link here between maximum long-term capital gains, corporate taxes, and personal taxes, and the government's ability to use some of those tax revenues to fund infrastructure investments. So we're going to get higher taxes, and hopefully we're going to get productive infrastructure spending. That's the key. What about tax rates and the economic activity picture? What's the link between tax rates and GDP and tax rates and stocks? And there isn't any strong link. This is the highest corporate tax rate, and this is GDP. High corporate tax rates, GDP is high. Low corporate tax rates, GDP is high and lower. I mean, it doesn't seem to be any strong link. Same with tax rates and the S&P 500 on an annual basis. So S&P, most of the average tax rates across the U.S. have come down, and equity markets go up, they go down. So here's a regression on real GDP and the maximum corporate tax rate. Very low R squared. Just another way of saying it's really hard to say with any degree of conviction that either the S&P 500 or GDP is dramatically impacted by the tax rates. Why is that? Because people adjust. That's what happens. People adjust. Okay, skipping some of the details of the plan, I'll just point out that it's really hard in a country that is evenly split to pass any kind of legislation that isn't in the middle of the country in terms of its ideological bent. So we're a 50-50 country. That was proven in the election, and frankly has been proven in every election since 2001. And right now, the Democrats enjoy a razor-thin majority in both the House and the Senate. And it's really easy, by the way, when trying to think about what's been proposed by the Democratic administration, the current administration, to think that it's all going to get passed just as it is because we passed everything else in the last 12 months. But the answer is it's really hard to pass legislation that impacts voters today via taxes. It's really easy to pass legislation that gets funded by debt. And frankly, time is running out. The political will in Washington, D.C. wanes with the vaccine rollout and the economic reopening. It takes the pressure off to produce a massive stimulus bill. And because the economy is recovering. The economy is recovering, and the pandemic is receding currently. So it's really not a question of what's proposed, but what can actually be delivered through a very finely, evenly divided Congress. So here, we reserve the right to change this at any time because, frankly, there isn't a lot of information yet. And as these American Jobs Plan and the American Families Plan wend its way through the committee process, and politicians are out on the tape talking about it, we'll get more information. But right now, the best guess on many of the bigger issues that the clients are talking about as it relates to tax policy would fall here in this category. Corporate tax rates, 25%. Personal income tax rates are going to go up probably back to where they were before 2017. Capital gains tax rate, probably 28. Don't know yet about step up in basis and like kind. And as it relates to the effective dates, could be retro on the personal tax rate, probably won't be on any of the others. It'll probably, though, be effective on the date of the enactment of the bill. This is subject to change. There's a ton of uncertainty around it, but I thought it best to at least throw something out there so we could address some questions that clients may have. Finally, I want to talk really quickly about Bitcoin. It's up 530% since October 1st. A lot of other things are up, but nothing like that. Bonds are up less than 1%. And this is why people want to talk about it. Bitcoin is up big, and I think there's a fair amount of fear of missing out on behalf of clients. But Bitcoin is a highly volatile asset class. Here's Bitcoin daily prices. These are the same scales, by the way. This is Bitcoin daily price movements. This is gold. So anybody that claims that Bitcoin is like a gold substitute isn't taking daily price volatility into consideration. It's one of the reasons why we would be less than enthusiastic about including a significant portion of Bitcoin or other cryptocurrencies in an institutional or a private client portfolio. But Bitcoin and gold daily price changes is goes a long way towards the argument that it's something you want to be very careful about. But Bitcoin has been adopted by a lot of entities. Bitcoin is now in the top 10 of all asset prices. Gold, of course, dominates at $12 trillion worth of market cap. Apple, the U.S. companies are in orange. Saudi Aramco, the national oil company of Saudi Arabia, is right in between Microsoft and Apple. And a couple of companies out of China, Tencent and Alibaba, shake out here, but Facebook is here, silver here. So Bitcoin has taken its place in the pantheon of large asset market value prices. Gold dominates, but it's grown. But it doesn't trade like a store of value. That's the problem. In fact, gold has declined while Bitcoin has increased. And I think there's been a bit of a substitution effect there. In fact, Bitcoin trades more like a risk asset or on a reflation trade. And I just don't know how to value it. So we've tried. It's not, there's no generally accepted fundamental value of Bitcoin. And as a result, it makes it somewhat less suitable. Can we determine it without an intrinsic or a fundamental value? Can you determine whether it's rich, cheap, or fair? No. Does it have a place in a diversified portfolio? If you want to think about it as a call option, they're a hot topic. Maybe it does, but it's not a store of value. It's not a currency at this point. And it's a hot topic because prices have increased dramatically, but that just means that the future expected returns are somewhat lower. So what are the implications for investors? I mentioned the last time we did the presentation that margin debt and leverage has increased dramatically. And I'm going to go about 3 or 4 minutes over if everyone can hang on for just a little bit. Bullish call option spike during the Reddit mania. So this is not good. Market accidents are caused by explosions in credit availability, and credit is very cheap and plentiful, and it may be fueling some mania. So we need to keep an eye on it. What happened yesterday? Well, with the inflation print, 10-year Treasury spiked, and these asset classes sold off. These are one-day performance as of yesterday. Stocks were down 2%. Small caps were off 3%. Bitcoin traded down almost 15% yesterday, but part of that was comments by Elon Musk and Tesla not buying anymore. But one-day spike in U.S. Treasury 10-year yields based on the inflation print, it was impactful. And it caused a sell-off. Things seem to be righting today, although I haven't looked at the markets in the last 90 minutes. Is our equities cheap? The equity risk premium versus the 3-month T-bill says it's a little rich, but not outrageously so. And frankly, if we're going to be in a lower for longer regime, maybe equities aren't overvalued. Earnings are recovering, and the market has historically looked through the recent earnings activity into 2022. We have a hard time looking at that and saying that's going to be a linear progression. So, but here's a very important. There's 2 very important slides here. One is that you're looking at S&P 500 annual returns and intra-year drawdown data. So for example, in 1985, the S&P returned 32%. And it had during the year a -8% drawdown. Large drawdowns should be expected. Most years, though, and positively, almost 80% of the years are positive. Year to date, in May of 2021, we've only had a 4% drawdown, and we've had another 3.5, for a couple of days. We may get a 10 or 15%er, but generally speaking, the equity markets tend to recover. So it's not a one-way ride. There are bumps along the road, but in the long run, investors are rewarded. So you should expect a 10 to 15% drawdown in any particular year. And just keep that in mind when things maybe get a little rougher going forward. Asset class performance year to date, instead of looking at just the one-day returns, the S&P is up 9%, large cap value is up 15, Bitcoin's up almost 70. And if you invest at all-time highs, historically, over the last 45 years of worth of data, over the last 45 years, if you invested on an all-time high, your return over the next 1, 3, and 5 years was 14. This is cumulative return, not annualized. Cumulative returns over 3 and 5 years are 40 or 7 or 80%. If you invest on any other day, it's still pretty darn good. But this tells you it's not a bad thing. You shouldn't exclude equity investment just because we're near all-time highs, because historically momentum takes you forward, and you can still do all right. So a couple of things to remember. Bottom line, I talked about financial repression, rates and rotation, and why we're cautiously risk on, but there are some risks to the outlook. And the biggest risk today is probably a tax policy error or a monetary policy error. We don't think it's going to happen, but because of the leverage and the Archegos thing maybe made us rethink that a financial distress situation of an important financial intermediary would be a real problem. That's a tail risk. We've already seen a big reversal in some of the Reddit trades and SPAC, and to a lesser extent crypto. Bitcoin seems to be chugging right along. But the biggest things, that are possible and highly impactful would be a persistent inflation hike and a tax policy error, and whether the Fed gets the monetary policy right. So we're keeping an eye on these things. But in the meantime, there are lots of things to do. There's lots of opportunities, and this is our list. We've been talking about these things since the third quarter of last year, when we rotated client portfolios into a real asset bucket to protect them from the coming inflation spike. That's panned out. Within equities, we're looking at just taking a little bit off the table in terms of our overweight to large cap growth, and now we have an overweight to large cap value, and have had for the last 4 to 6 months. We've added a little bit to small cap, and are looking at now a rotation after U.S. markets have significantly outperformed international markets for much of the last 8 years. Non-U.S. equities are starting to look a little more attractive. Credit markets, we like high yield and like inflation protection in the form of infrastructure, real estate, and tips. Like precious metals and particularly natural resources, we saw a lot of data on how commodity prices have exploded. And again, if the dollar's challenged, the non-U.S. assets will be favored. Financial repression is very challenging for fixed income portfolios because a negative real interest rate is purchasing power destructive. So we do need to address it, and we're addressing it with some of the strategies here. That takes me to just a couple minutes after time, and I'm going to go through some questions really quick. What extent do you see global supply chain shortages impacting the recovery? They're transitory. Supply chain disruptions are likely to resolve over the course of the next 12 to 18 months, so fiscal stimulus will overwhelm it. There was another question about supply chains there. I hope I addressed it. They are inflationary, but that inflationary impulse is probably transitory. What do I mean by out of growth? Sounds like you will be removing growth from portfolios. No, we never remove completely sub-asset classes. We do move the portfolio a couple of percent here and there into assets that seem to be rich, out of rich assets and into fair assets. Out of growth means taking the 2 or 3% overweight we had and make it either a neutral position or a 1% overweight, so that we can fund a little bit of a bigger overweight to value. So we just like value better than growth. Guns and butter. Can we recalibrate our military spending to help offset the deficit? Possibly, although that doesn't seem likely given the geopolitical challenges we face both in the Middle East and in Taiwan, which is probably the most dangerous place in the world. Yes. So what if our culture fostered an era of being healthy to reduce medical? There's a lot to unpack here. You're going to have to send me a note, and I can address some of those questions offline. Fed's primary tool to fight inflation is raising rates. Yes. Can they raise rates materially? No. So that would crash risk markets, which is why they're not going to do it. Instead, to fight inflation, they're not going to fight inflation. That is, their average inflation targeting allows inflation to remain, to be run hotter than normal. So we're going to do that. I don't think this is from a client in Arizona, talk about stagflation. So I don't think we're going to get stagflation because of all the stimulus that we see in train, but it's possible that once the stimulus gets through the system that we might have lower growth, but probably something more closer to potential GDP growth and higher inflation, but not hyperinflation, which is some people are worrying about that given the money supply. What amount of student loans will be canceled? That is undeterminable at this point. I don't know. Can we get a link to the presentation deck? I'll run it through compliance, and if we can, we'll post it on the website. And other questions relate specifically to, I think, personal client situations. I would say this, one of the things that we really like in US credit markets is private investments. Private investments in credit should be viewed in the context of their after fee performance, as would any private investment. Private investment vehicles are more expensive than traditional investments because they require specialized expertise to access what we refer to as information asymmetries in the marketplace. By locking up your money for a couple of years, maybe up to 5 or 7 and 7 to 10 for private equity, private credit funds do a really good job of producing excellent income and after-tax returns because they are difficult to access, and because of the difficulty, they have higher fees. So just keep that in mind. It's not about necessarily what something costs, but what it does for your portfolio over 5 to 10 years in terms of a return. With that, it looks like we are bumping up against the final minute or so. This is a big one. What would you view as the traditional role of bonds in the portfolio? Do they still belong? Absolutely, they still belong. You want to shave exposure to bonds down, like we've done. Try to put them in some of these other things, particularly real assets, to protect from the current and potentially persistent, we don't know yet, higher inflationary environment. And the idea that that bonds should be a part of your portfolio is something that you can't argue against. They will still perform the traditional hedging function that they have in a 60-40 portfolio, just less because interest rates are so very low and real rates are negative. So the cushion that bonds provide is less than it has been, so it will be less of a good hedge. And also it's a negative carry trade from a purchasing power perspective, which is another way of saying negative real yields are a little bit more painful than positive real yields. But bonds will exhibit lower volatility. Hopefully they will continue to exhibit some either low or negative correlation to stocks. So yes, they should definitely still be a part of the portfolio, just less so and tilted into some of these others. Bitcoin is a synonym for crypto. No, I'm really focused on Bitcoin. The other cryptos we haven't done a lot of work on, so I don't want to comment on Ethereum and Dogecoin and some of the others. Bitcoin is the big one, and it's not. We don't have a strong opinion on any of them, but Bitcoin is the one we talked about today. What I described as common perception on Wall Street, am I worried the trade is crowded? No, because we were in it 9 months ago before it was crowded, I guess is what I would say. We were well ahead of the inflation expectations curve, and we just think it's going to persist. So clients that have been part of Beacon Point since last summer have already taken advantage of some of the real asset protection and other and credit opportunities that have performed very well. So yes, I worry about the potential that it could become a crowded trade at some point, but right now there are no better alternatives, even though they have these assets have increased in value. They still seem very attractive to me. Okay, we're going to wrap up in the next minute or so, and let's see. Okay, so no, that's the last question. If there are further questions, we can address them offline. I want to take this opportunity to thank everyone for listening. It's been our pleasure. For those that are clients, thank you for your faith and trust and commitment to Beacon Point. Know that we are committed to helping you achieve your objectives, whatever they may be. And I look forward to speaking to many of you in the coming quarter. And for the rest, we'll do this again in August. Thanks again for your time. Thank you. Bye now.